the equity markets, the rotation out of tech. So you're going to see, the Dow and the S&P are probably going to be higher, where the Nasdaq's going to be lower. And if the market moves lower, it's going to be led by the Nasdaq now. So let's, what I was going to do today, and I thought I'd do this for you guys because we haven't done this in a while, but I think it's something that's of good practice.
Bias chart.
Yeah, we're going to start doing the bias chart, and I'm gonna jam through these really quick because I think this is a really important exercise for all of us to do on a daily basis. So first thing, let's look at the euro dollar, and the euro dollar, resistance is going to be 114.87. That's 127% of this entire move. So 114.80, I think 8. Bias is going to be bullish, and the support now should be at 113.90. So, and you could probably give it all the way down to here, but I'm going to go with 113.90 at this point. Because you don't want it to be too much of a false breakout. So 113.90. So as long as we're above 113.90, it's bullish. Let's take a look at the cable. Let's go over to the pound, and the pound's going to be facing some really, really key resistance right here. Obviously, it's a big downtrend line, and it's horizontal resistance. So that's 126.66. So I'm going to keep this range bound for right now, 126.66. Whoops. And then support. Now, if we get a dip in the cable, this should offer some support. You can see this previous line support here, horizontal support there. This is a breakout point. So this should all offer pretty good support for today at 125.65. And I doubt we get there today, but I got to write down. Okay. So let's go over to the Aussie. Okay. Here's the Aussie dollar. So the Aussie is obviously breaking out. So now you have to think that any dip right here is going to be very well supported. Let's just say roughly there to there. So any dip to 69.95 roughly. 69.95. Bullish. And resistance, well, first of all, we've got, this is really key resistance up here. You can see the spike highs from way back in December of 2019. That high will come in, or those highs will come in at 70.35, I think it is. And then above that, so it goes 70.35, 70.50. Reason why I do 70.50 is because, obviously the spike high up here is, it's 70.60, 70.62. Okay. Trying to cruise through these guys. Kiwi. All right. So here's the Kiwi. Kiwi's obviously, facing some pretty key resistance here at 66 cents. Now, any dip has been supported at 65 cents. So, and while we're above, and I'm going to put an asterisk there because that is important. While we're above 65 cents, you got to assume that the Kiwi is bullish at this point. It's, well, actually, you know what? I'm going to keep that range. It's really got to break above 66 cents, and a break above 66 cents is bullish. All right, let's go over to the dollar Canadian. Dollar Canadian, this is a currency pair that has really outperformed well, and I'm going to say, well, it's above the 200-day moving average, which is also a lot of horizontal support down here. Let me move this over. This is the one currency pair that's really, should have you, very, very careful with dollar strength, is when you have this, this dollar Canadian that's just kind of, not following through. That's not to say it won't follow through with dollar weakness. It should, but it's not. and so we've got to respect that. So I think today you can see this move right here. Let's get rid of this really quick. If we come back and retest this trend line, that could take us all the way back to 165.35. All right, so that should offer support, 165.35. I'm going to say it's range bound for now. Resistance, any move back up towards, it's hard to say. I would say that for today, any move back up towards 136.30 is going to find sellers, but this is more range bound now. 66.30 is resistance. Okay. Let's take a look at the Swissy. So the Swissy took off. The Euro Swiss is rallying pretty aggressively. So support here is going to be at 93.70. You can see the spike lows down here. False breakdown should lead us to a breakout. This is another one that's the dollar is actually acting a little bit better, but that's more intervention effort, I believe. So 93.70, it's going to be pretty key support. Resistance, let's see here. So you got all of these, this, like this is a whole resistance zone up here. So I would say this spike high right up here is going to be resistance around 94. Let's just call it 94.50 by the time we get there. Oops. That's resistance. Let's go take a look at the dollar yen. The dollar yen is it's actually moving lower today, even with equities moving higher. So we're going to be coming into some support right through here, which will be at 106.60. Let's see if that can even hold here. I'm going to go below. There's 78% retracement that comes in at 106.54. So I'm actually going to write that down on the dollar yen. It's going to be 106.54. Because that's going to be a 78% retracement. Because even if we break these lows, you got to assume that we're going to find some support right below there, and you can see the horizontal support from over on the other end. Now resistance is 107.25. Okay, 107.25, and you know what? This is range. Dollar Swiss is also range. I want to go back really quick. Just let me just make sure the dollar Swiss. The dollar Swiss is it's really all. It's really just more range bound than anything. Whoops. Let's get that back. Hold on, really quick. Okay. Next up, dollar index. Let's take a look at the Dixie. So here's the dollar index. Dollar index approaching horizontal support. Now we're already below what I would consider trendline support. So it's bearish. Obviously the bear flag's trying to play out, but this support right here at 95.70 is going to be key. 95.70, that's going to be key. Now resistance intraday. I mean, if for some reason the dollar index comes back and takes out this level, that would make it pretty bullish intraday. That comes in at 96.25. So 96.25. That should be resistance, and we are in a bearish trend. Okay. Let's take a look at the dollar MEX. The dollar Mexican peso. Now this is like the dollar, dollar Canadian. It's another pair that that's holding up really well. And as you can see with this fib here, okay, this is the 618 retracement that comes in at 2213. Horizontal supports at 2215 roughly. So I'm going to put 2215 is pretty key support here. Okay. Resistance, I mean, let me get rid of this really quick. I want to just keep that down here. Resistance still is 2279. And while we're below that, you got to assume, let's just call it 2280. You got to assume that we're in a bearish trend, but this is the type of currency pair that will turn instantly bullish if we get above this downtrend line. It will, because that means that this bear flag is not, this pennant that you see here is not following through. Okay, so I'm kind of staying away from these Nordic currencies right now. So I'm gonna delete this for now, and I'm gonna delete this for now. And I'm going to keep the bias chart just as you see it here. And maybe what I'll do on top of that really quick is, let me think about that for a second. Because I'm not really trading actually the US dollar Norwegian krona. I can keep that up here. Let's talk about that real quick, because it is bearish. The US dollar Norwegian krona is attempting to break down. And this is one of the things that you have to realize with the US dollar Norwegian krona is the bounces are very shallow. So the risk is if we break through this 916 level, we should take on like the 9 level. And the 200 day is capping, so that comes in at 955. Okay, 9, and so this is bearish. Oops. Okay, so here's your bias chart, guys. Like I said, this is something that we used to do every day, and it's something that thinking about it overnight, it's like something we need to be doing every day. I know if you listen to Paul Franco's webinar, you get his bias chart. So you guys can take a picture of it, whatever you want to do. I'm going to leave it here for you for a second, and I'm going to bring in Steve and Stelios. Good morning, guys.
Good luck in bringing Stelios, but you have me.
Oh yeah, that's right. That's right. Paul said we may want to check the Canadian numbers. Oh, did I not? Oh, it says 135.35. My bad. I don't know why I was putting in 6. 135 and 136. Sorry, guys. Okay, there we go. Those are the numbers. There we go. And the dollar Canadian, like I said, just regarding the dollar Canadian, it's just while we're outside of this down channel, you got to be really careful getting too bearish. The dollar Canadian, every time you think about getting bearish, it pops its head right back up to 136. And I feel that that's going to be the situation while we're above the 200-day moving average. Okay, I know that the Bank of Canada is today. That is something that we do have to take into account. But believe me, if you're bearish the dollar Canadian and you're trying to get on the short side of that, I'm sure you're equally as worried about the Bank of Canada today about being a little bit more dovish. So anyway, hope that all finds you well. And Stelios had to run. So that's right. So Steve, how's it going?
Yeah, good. How have you been, mate?
Good. I had a little bit of troubling news overnight, but other than that, just staying quarantined pretty much. So not much. How's life in Greece, by the way? You guys, I mean, is everybody out and about just wearing masks pretty much?
Without the wearing mask part.
Oh, so everybody's out and about. No one's wearing masks.
Most people are out and about, and the vast majority are not wearing masks.
The vast majority are or are not.
Are not. Are not.
Really?
Yeah, the overwhelming majority, I'll tell you.
Wow. So and I guess your COVID cases continue to be all right.
They've spiked a little bit, but still, I mean, very much under control. But let's hope it stays like that.
Yeah, right. Okay. Well, we have some data coming out right now, but
Yeah,
as I
New York
mentioned,
Fed.
yeah, we got the New York Fed manufacturing data. We got some minor Canadian data, but as I mentioned to you a bit ago, Steve, or to everybody here, I think it's going to be good practice doing more of the bias chart. So
Yeah, although in this market environment, I mean, take the USD CAD as an example, can prove to be a false break. I mean, we get a lot of those lately because the markets are really, really bad. So,
yeah,
yeah.
yeah, it's a challenging environment. There are a lot of false breakouts, and that's one thing that I think we need to keep in mind with like the Aussie dollar, just because the Aussie is, man, how many times have we been up here and then failed? So you got to be a little careful with the Aussie as we're trying to break higher.
Yeah, I actually bought this breakout. I also made a pattern play, but needless to say, I'll be watching it very closely because yeah, this is the environment.
Right.
Better in New York Fed numbers 17.2 versus 10 expected, and Canadian manufacturing also somewhat better, 10.7 versus 9.5 expected. So better manufacturing numbers, both from US New York Fed and Canada.
Got it. Okay. Well, the dollar isn't reacting much. We're still seeing, the euro dollar, hold its bid, and I think the euro dollar. This is a pretty bullish move in the euro. Even though we've been expecting the euro to break higher, it's been a slow starter, and I think that with the ECB tomorrow and with the European Council meetings at the end of the week, it's either going to make it or break the euro. But as of right now, and we have to assume, especially with the equity markets as bullish as they are, you've got to assume that that in itself is going to carry the dollar weakness. So
I see that there is still. I mean, whenever people ask me about the markets, even people that are not involved in the markets, I see a lot of pessimism surrounding the euro, which makes me think that this climbing the wall of worry can actually with a couple of catalysts can prove to be quite a massive move higher. And I'm assuming that the market is really not going to be ready for such a thing. You know what I mean?
You guys, can I ask you guys a question?
Yeah, sure thing.
You guys, does the direction of EG give you any type of feel for direction in the euro? And could it give you a clue of, the dollar being good or the dollar being bad, say when EG is heading up or EG is heading down? Or is it just, it's just really, there's no directional interpretation from it?
In my opinion, there's no directional interpretation.
Okay.
Yeah, and
that's what I'm coming to believe.
And for me, it really depends on what the euro pound is doing. If the euro pound is breaking a really big support or resistance, then that is gonna influence what I'm doing with the euro or the cable.
All right, thanks, guys.
Yeah, it's got to be something
significant.
Yeah, like if I was looking at the euro pound and it was just making a real big move like this.
Yeah.
But anyway, that's a great question. So guys, I'm gonna pass it over to Steve. Here's one last look at the bias chart. Dale, have a great interview today.
Oh yeah, Peter Bookvar is going to be with us.
Oh, Peter's going to be
nice.
awesome.
Yeah.
You guys got to hang around for that. Obviously, Peter's the bomb. So, I'm going to pass you over to Steve, and he can cover all the other indices that I didn't go over. So,
good hunting, Blake.
All right,
Thank
thanks,
you, Blake.
guys.
See
All
you
right,
later,
thank you.
mate.
Thanks. See you, Steve.
Bye
Thanks,
bye.
Dale.
Good afternoon. You're welcome, Blake. Good morning. Good afternoon, Steves, plural.
There's no Steves.
Oh, just singular.
Yeah. Stelios had a car issue, so
Oh,
at the last moment. Yeah, so he had to.
Guys say most men's problems are either cars or women.
I think Stelios is fine on the women part.
Yeah, so he deserves to have car trouble then. Steve, I was wondering with the recent action with NASDAQ, and you were showing that chart of the spread of NASDAQ outperformance on S&P, if the last few days action is changed, are there any cracks starting to show in that spread?
That's actually a good mention, and yes, we've had a reversal now. Admittedly,
yeah,
admittedly, we've had a beautiful evening star formation, but admittedly, I mean, just
so much
like
mo.
yeah,
Look at that RSI.
We're just back to all-time
Yeah.
high levels that we saw like 7-8 trading days ago.
Okay.
So is this enough to tell us that that's it? No, I mean we're far away from that. I remind you that the orange line here is the all-time high that we had seen at the peak of the tech stock bubble in 2000. Yeah. Yes, exactly.
Yeah.
So we actually penetrated through that
and we're
level.
Coming back to check that high now.
Perhaps retest it, or even this like broken wedge.
Yeah.
So it's very hard to call a top just because of some type of a reversal. If you remember, this is also the reason I was quite skeptical yesterday. I mean, I said that it's a big reversal that we got, but somebody has to be very, very careful and skeptical because this is the market we're into. I mean, that any type of rumor, any type of news bomb, like one day is going to be the vaccine, another day is going to be if they need it, they're gonna unfreeze, the joke that's called the U.S.-China trade deal. It's gonna be perhaps poll numbers or who knows what. I mean, this is a market that is really high on drugs, and by drugs in this case, since we're talking about the financial markets, we're talking about trillions and trillions of monetary stimulus. So plus,
I bet on that key reversal in NASDAQ though. So that
to be
happened.
Honest, the NASDAQ so far has recovered only
right. That's what I'm saying.
Yeah. So the NASDAQ admittedly hasn't yet invalidated the reversal we got the day before yesterday. But as I was very careful yesterday with saying that, under normal circumstances, I would be like more than convinced that we're going to see a follow through. But I said that I want to see at least one more day of confirmed follow through before I get more enthusiastic about it. And at some point we were trading quite negatively, and look at how we closed the day by leaving behind the hammer. As you said, the outside black candle that we got for a reversal hasn't been invalidated yet. In the case of the S&P, it has though. So that's something we need to take into account. Keep in mind that if we're talking about the S&P 3260, it remains a nice confluence of resistances, and we're currently quite close to that. Also, keep in mind that soaring
What's there
risk,
at 3260? Steve, what do you see there? 3260.
It's the 88.6% fib from the all-time high.
Okay.
It's also horizontal support resistance area.
Okay. Thank you, buddy.
So keep in mind also that this, risk euphoria has also brought along this breakout in the Aussie USD. So we're now seeing the Aussie USD after, quite a decent amount of time consolidating in this triangle. We seem to be breaking above it as we speak. Not that much of a surprise. I mean, we've seen that the Aussie has a formation and had been trading in lockstep more or less with the S&P for quite some time, not with the Nasdaq but with the S&P, and the S&P seems to be doing quite nicely. So the Aussie managed to break out as the DXY is still dripping lower. If you remember, one thing I focused on yesterday was the fact that the DXY did not find a bid despite the risk reversal that we had. So, I said that by the end of the day today, that was yesterday, I want to see if, this little divergence with the DXY being sold while risk assets are also being sold at the same time, which was quite peculiar. If we're going to have another day of that happening, or we're going to, return back to the inverse correlation. And we did return back to the inverse correlation just because indices actually reversed higher. I have to say, though, that the fact that even for roughly a day, the dollar was still being sold despite risk assets moving lower, in essence, is sending really worrying signals for those that are bullish the dollar. What is even more worrying, if you ask me, and I saw this yesterday again, is the fact that the Euro USD seems to seems to be breaking above this descending channel. Of course, it's early on the day. We still haven't had a daily close above it. I mean, we will if we stay well bid today. But I do consider this an important formation to monitor, and I do believe that there is a very high probability that we've spent all this time in essence building a rounded bottom here in Euro USD. And if you remember, I also said that I'm quite bullish the Euro USD. I'm actually thinking of turning my trading account back to euros in the longer term. I mean, I benefited a lot from being passively long the dollar for many years, but I do see that the danger is that the euro is going to appreciate quite substantially. Of course, tomorrow we have the ECB, and the ECB can provide the catalyst for this breakout to really accelerate to the upside, or for it to perhaps show us that it wasn't a real breakout. But even if that's the case, even if we assume that the ECB will turn the euro lower, I'm still not going to be looking for a lower low or whatever else. I'm still going to be looking for support to to be found quite soon. So I still believe that the euro USD is looking quite nicely. And I still believe that the vast majority of the crowd is bearish the euro USD, which is another sign that that might actually blow up in their faces. Now, euro USD is breaking higher. Aussie USD is breaking higher. The Kiwi had already broken higher earlier. The pound had quite a negative day yesterday up to a point, and then reversed higher to close unchanged on the day. More or less, it followed the reversal higher in stock indices. And we're seeing quite a nice follow through to the upside today. So, it remains well bid. Keep in mind that 127 is a confluence of resistances. It's a 78.6% fib and the 200 daily moving average. But I do think there is a very decent likelihood that the cable is also going to try to attack the long-term descending channel as the Euro USD has done. So here is the equivalent long-term descending channel here in purple. So I think we might actually do that. So I wouldn't really try to fade this. Now, clearly, if these breakouts are legitimate, it puts a big question mark of if this breakout in the USD CAD is legitimate. I mean, yeah, we know that the Canadian dollar is definitely underperforming a lot of the other currencies, especially when we look at it against the dollar. And we've said that being long USD CAD is probably one of the best ideas if you really have to be long the US dollar. But I think there is a decent chance that this might prove to be a false breakout. And not only that, there is a decent likelihood that the pair is building here some type of head and shoulders formation, right? Shoulder, head, shoulder. So, I would be quite careful here. I'm still short USD NOK, and, good thing I didn't get rid of that position. USD NOK is about to attack, new lows, and I still strongly believe that there is a very good likelihood that this might have even been some kind of a like generational high in USD NOK. And I do still think that there is a lot of value in being short USD NOK if we're talking about long-term trades. Now, I'm not saying that if I didn't have this position, I would be selling it, here, but I'm definitely holding on to my position for a long period of time. So, USD NOK also looks bearish. Look at USD SEK. USD SEK got rejected once again from this descending channel trend line resistance and has turned lower once again. In general, US dollar looks, really, really bearish, more or less against, everything. So, it is what it is. The dollar index is approaching the previous low that we had there. Below there, we have the 94.65 spike low, and below that, there is really, there is really a lot of thin air. I mean, I can easily see the dollar plunging lower without, much of a support following that, meaning, it's a very dangerous proposition being long the dollar. The only thing that can save you likely is a sustained reversal lower in risk assets, because, even an aggressive sell-off for a period of a few days, I don't think that's going to be enough to really, for the dollar to really strongly recover. I mean, yes, if we get a sell-off, definitely the dollar sell-off is going to pause, and we will see some type of a rebound. But do I think that's going to be something like massive? No, I doubt it. So I do think that, the path of least resistance in the case of the dollar is clearly to the downside for the time being, and, especially as long as we remain below 97.75, which was the high, the double top that we actually found once we had this rebound that started in the middle of June and, in essence, finished at the end of June. So it lasted a couple of weeks. So having to do with the rest of the indices, as I said, 3260, quite a key resistance area for the S&P. Now, if we do break above it, then we're looking for levels above 3300. It doesn't matter how, improbable it looks like, or how stupid, or if it, if it makes fundamentally sense or not. You have to respect the flows, and you have to respect the trend until it proves to change. And, so far we we haven't seen really much of a change. CAD equals oil. The oil is up. Why the CAD is not up? Actually, first of all, crude oil is part of the Canadian economy. Yes, there is no question about that. But that's not all about it. I mean, the Canadian economy is not all about oil. I mean, it's not, the Saudis, right? Second of all, in general, you'll notice here that the Canadian dollar, in general, has been appreciating as crude oil has been appreciating as well. I remind you, this is a chart of USD CAD. So, when the Canadian dollar strengthens, USD CAD moves to the downside. So you'll see that, despite the relationship not being like extremely strong, still, if we overlay, sorry, I made a mistake here because I should have actually overlaid the inverse of US oil. So if we overlay the inverse of US oil, whoops, well, I obviously did something wrong. Isn't this the symbol? Okay, why isn't it working? Okay, I'll have to do it oppositely then. Anyhow, if you look at crude, so we don't have to spend much time, crude has been moving higher at the period of time that USD CAD has been moving lower, which is exactly what you should be expecting. Okay, now there are divergences. I mean, it hasn't been moving lower in the extent that US oil has been moving higher, WTI has been moving higher, but in any case, the relationship is more or less there. And yes, crude oil, since you mentioned it, it looks like it's about to break higher. There it is. I said since the beginning that this type of consolidation, tells me that there is a higher likelihood that we're actually going to break higher than lower, at least initially. I don't foresee that the breakout is going to be long-lived because I do think that at some point we're going to have to see crude oil, post some kind of a deeper corrective move, exactly as stock indices. I mean, at some point, stock indices, no matter how decoupled from reality they are, they will have to produce some type of a deeper correction. So at that point, I'm assuming that crude oil is also going to be producing a corrective move lower. Now, might happen from 42, which is an area of interest, might happen closer to 45 because 44.80 is the 61.8% fib, but it's going to happen. Now, having to do with, because we always have questions, I mean, every single day we have questions about gold and silver, nothing has really changed here. Gold remains in an ascending channel. Silver remains in an ascending channel. Silver, admittedly, testing, quite key resistance area. Gold very, very close to a nice confluence of resistances, which is at 1824. But in any case, they both remain very well bid. They both still trade in an environment that is extremely supportive for monetary metals. So
Steve, what's the
fading them.
gold silver ratio look like to you?
Gold silver ratio is
It's
still
making
performing.
new lows for this move.
Still performing quite nicely, meaning still pushing lower. Entering now this previous high area.
Yeah. Okay.
Right.
Mm-hmm.
I mean, this rebound higher was clearly corrective. I mean, the price action was indicative of a corrective move. Already a beautiful pullback from the 130 all-time high, which was a ridiculous level. I mean, it was like historically, it was an astonishing ratio. I mean, 130 ounces of silver for 1 ounce of gold. It was clearly silver had become very, very very, very inexpensive against gold, and I think that people realized it and switched some of their gold to silver, which I think they did very well. You should be holding both of them, but it was.
We told them to.
We did. We told them that it's probably going to be short-lived.
Go get 120, 30 pieces of silver for your 1 ounce of gold.
Yeah, and worst case scenario, you can turn it back, right? I mean, if you did that at 120, I mean, obviously, top picking is not easy, but even if you did it at 120, you can just turn it back to gold as we speak, and you made quite a nice, extra profit in gold terms in very, very little time, right? But keep in mind that historically speaking, even after such a huge move lower and sharp move lower,
I remember the 40s.
Yeah, silver is still expensive against gold. So, don't think
cheap.
It's still cheap against gold. So don't think that this move lower in the gold silver ratio can't continue. It actually can. I mean, I wouldn't be surprised to see it down at the 80.
Yeah. I mean, for decades it was, 40.
Oh, it was a lot
60.
lower for decades. Yeah, a lot lower. Yes, very, very, very true. EURUSD.
I remember it all the way back then, man.
A lot of people, I even see here in the chat box, a lot of people showing disbelief in the EURUSD move. You should be careful. You really should be careful. That's what I have to tell you. A question about natural gas, nothing to do here. Natural gas exactly in the middle again of this range. This range dates back to the beginning of the year. $1.50 to $2 roughly. We're more or less in the middle of the range, so nothing to see here. I do eventually expect the natural gas to break through the $2.05 dollar resistance, and I will be very, very interested in buying it when that happens. But until that happens, I just monitor it and nothing more than that. DXY we did cover, gold silver ratio we did cover, DXY another question we did cover, gold we did cover. Oh yeah, let me there are a couple of things I wanted to talk about. One of them, if you remember, I I said yesterday that the day before yesterday I showed in the chat room the Euro Swiss breaking to the upside, which usually is a risk on signal. And specifically yesterday when I showed this, I expressed, my disbelief in, this clear divergence, meaning Euro Swiss was still pushing higher while risk had turned lower. So, something had to give. I mean, either Euro Swiss breaking higher would, need to reverse lower and prove that it was some type of false move, or the reversal lower in stocks would have to prove to be a false move. So far, the latter seems to be the case. I mean, the reversal lower in stocks seems to have been the false move. Euro Swiss is doing perfectly fine for the time being. That is the reason why you don't see the USD Swiss continuing to the downside despite the Euro USD breaking to the upside, because the Euro USD breaking to the upside would be forcing USD Swiss to move lower unless we would be seeing the Euro Swiss appreciating, which is exactly what's happening at the moment. So Euro Swiss appreciating is in essence putting a floor for the time being in the USD Swiss and preventing it from continuing lower. I do think that there is a chance that Euro Swiss is going to squeeze higher from here. I mean, as long as the risk assets remain well bid, I don't see any reason why we can see a higher high here in the Euro Swiss, with the first area of interest being at 110. So keep that in mind. Yeah, we had an issue with YouTube, some type of a bug. I think they fixed it now because somebody mentioned it. Questions about Blake, why there is no gold or silver. That's an FX chart he showed. It's not that Blake doesn't follow gold and silver. He does. He not only follows them, he actually, I can tell you, firsthand that he also trades them. With stocks on risk on fire, why can't Aussie yen break out? Something not right. Yeah, I will tell you what's not right. That's an easy answer for me to give. What isn't right, I don't know if you can call it right or wrong, but what is preventing Aussie yen from following through is this. It's the USD yen. So, until several months ago, today, with risk being well bid, would definitely, be also spilling over to USD yen, meaning that you would expect USD yen to move to the upside. USD yen, oppositely from what somebody would find absolutely natural until a few months ago, seeing USD yen moving higher, meaning investors selling the yen because the yen is a safe haven currency, right? We're actually seeing the opposite. Why are we seeing the opposite? Nobody can tell you for sure. If you see, even in the short term, there is also some type of a decoupling from yields. I mean, for the time being today, yields are a little bit higher, admittedly still near the lows. USD yen moving to the downside. In general, as we've said, risk has decoupled from bonds. So that has led mostly to risk being decoupled from USD yen. Now, an important question is, what is USD yen following? it is somewhat following yields, but on occasion, not even those. I mean, USD yen really looks like a currency pair that is pegged. That is why good for me and good for anybody that has been listening to my advice, because I've been saying the same thing for months. I've almost even completely stopped looking at USD yen. I mean, at some point, USD yen was constantly on my screens. It was always one of the charts that I had, open on my screens. And nowadays, I just have a look at it like 2-3 times per day, and just to do it. I don't really understand why people would even trade it. And that is why I've really also refrained from trading any yen pairs, because you can't really tell for sure what they're going to do, because you can't tell for sure what USD yen is going to do. In any case, yes, Aussie yen is not really performing that well due to that. But on the other hand, the correlation is somewhat there still, right? So if you overlay here the S&P, for example, so here it is, you'll see that, there is still a relationship here, right? So
Everyone wants things to happen right away.
Yeah.
And sometimes markets have delayed fuses. So
that is very true. That is a good point, Dale. Yes.
We all want, when we're in a position for it to start working, and, a phenomenon, and I'm going to bring Peter on, is that you could hold a position, and the longer you hold it, I don't know if it happens to you too, buddy, but even if price isn't moving against me, I start to think I'm wrong just because it hasn't begun to move in the direction of the plan.
Mm-hmm.
So, that's just psychology. He hasn't done anything. But the longer you wait, sometimes the more doubt could creep into your head. Anyway, just sharing my
No, I'm 100% with you, and we've said many, many times that trading is mostly
all in our heads. Yeah.
Yes, it's mostly a psychological game, right? Game in quotes, of course. In any case, I really want to see what Peter has to say.
Yeah.
About these markets, what he thinks both about the economy and about
In fact, why don't you stick around and ask him a question or two?
Yeah,
in case
absolutely.
I don't hit it, if you have time.
It's going to be a pleasure.
Okay, so Peter, welcome back, buddy. All of you, Peter's work is shared on CNBC quite a bit. Yeah, hi, Peter.
Hey, how are you?
Good. Thank you for coming back, buddy. How are you? Everyone safe in the family?
Yeah, thanks for having me on. Yes, hope the same with you guys too.
Okay, Steve, so I'm going to share if you stop sharing, and we'll get Peter into it. So Peter, okay, thank you. So Peter, since the summit, we've had dollar weakness, euro, finally clearing some resistance levels. So I think this must have been constructive for the positions, emerging markets, with the dollar pressure coming off. Is that the way you see it? And you looking for continuation?
I am. I mean, the euro trades pretty impressively. I've been saying this for a while. When you think about the things that have been thrown at the euro the last 5 years, 6 years with negative interest rates, sclerotic growth, a yield curve that's disappeared via the ECB, pressure on bank profits, political ups and downs, and the euro still is trading between this 105 to 115 range now, obviously on the upper end of that. I do think that the exploding U.S. debts and deficits are beginning to matter. This move above 114 in the euro coming just a day after we were told that the budget deficit through June is going to be $3 trillion, which is about 14% of GDP. Now, we obviously know why that's the case, but one thing we did not see in the expansion was any compression in the budget deficit. And one country's budget deficit definitely has a correlation to the value of its currency. And I think that that's having a factor here on weighing on the dollar, which will help, as you said, emerging markets relative to the U.S.
Okay. So what's number one on your radar screen after this major retracement. Back in March when the S&Ps were trading 2,200, calling for a bear market rally back to the 3,000 level, they wanted to lock me up. So this magnitude has surprised me. What's your take on it? And do you think that perhaps this week we're finally seeing the separation between tech and being NAS 100, MAGA, whatever you want to call it, that they're finally going to correct in some way, like they are, like today with the S&Ps being much stronger than NASDAQ?
Well, it is possible that on Monday, when we had that reversal day in the NASDAQ, that was maybe a short-term top in the NASDAQ relative to other things. Obviously, when you see names like Tesla, putting aside what you think about the company itself, but when any stock, regardless of what it's called, goes parabolic, that's usually a late phase situation. And we know a lot of the names in the big cap area have gone parabolic here. So with the dollar weakening, with hopes that we will have a vaccine sometime early next year, with the success we're seeing right now, that we could get a shift into cheaper things, more beaten up things, and away from the maniacal chase into technology stocks, which have put valuations at pretty extreme levels. Not that valuations are a timing mechanism; they're certainly not, but certainly a disconnect between one area of the economy, which is still economically sensitive, relative to something else. I think that separation probably, for now, has run its course.
Do you think COVID is out of control in America and we're not wanted anywhere? We're like pariahs everywhere in the world now, Peter, and a lot of states beginning to, in fact, mayors that do no longer have the power to legal authority to call for a shutdown. The governors have to do it. Do you think that if we continue on this path that we're on, that it's not factored into the market, and people are saying the economy could recover? Wasn't this a pretty big body blow, no matter what the Fed and the U.S. government's doing with relief money? How long can that work?
So in terms of it being out of control, it's certainly in some states, but just because something's out of control doesn't mean you can't get back in control. I think just as we saw in the Northeast, sort of in April, how we were able to get back control, I think just a few weeks of mask wearing would go a long way. But this is still a traumatic experience for the global economy. It exposed a lot of vulnerabilities of the global economy that are just getting sort of band-aided up by the Fed and fiscal policy, but that those band-aids definitely wear out after a period of time. And we know in a couple of weeks, extended unemployment benefits expire. I'm sure they'll extend them to some extent, but at a lower rate. The PPP money for many businesses is running out, and monetary policy has a law of diminishing returns. So there is going to be a point within the next 3 to 6 months where the economy does have to stand on its own. And even if you do get a vaccine, which I'm confident that we will, it's still a 2021 event. And we have to ask what kind of economic damage is still going to be ahead of us from now until then. How many
especially into a flu season where people won't know what they have. And this winter could be a pretty tough season for our hospitals to be able to function.
No question. There's still a long road ahead until the masses are inoculated again, which is not till 2021. So even if Moderna has success, we still have to power through what will still be a bumpy 6 months. And I go back to small businesses. Small businesses are living day by day right now. So today the market's celebrating Moderna's news, but that small business still has to make it out to the other side in 2021, and unfortunately, some won't. And that is again because a lot of people in the country in different parts are not being disciplined in wearing masks. Mask wearing has proven to be a success in containing the virus in many parts of Asia. And I think we should be looking to them as a template. It's not perfect, but when you look at the spread numbers and the death numbers there, it does tell you that with proper discipline, we can get through this. But right now we don't have it. Businesses are going to suffer. Confidence is going to suffer. And while 2021 hopefully will be better with a vaccine, again, we don't know how much economic damage we're going to see from now until then. So yes.
And doesn't a lot of consumer spending, Peter, come from people 50 and older? They're really the bulk of consumer spending, and they're going to have some type of. I know for myself, I'm not in a hurry to go to a restaurant, and that also that demographic could have an impact on maybe a very weak consumer recovery.
That will definitely be a factor, and then also you have higher income people that are a big chunk of consumer spending. And even though they're certainly enjoying this rally in the stock market, they've even reined in spending. And that'll be one of the lasting characteristics of this recession, is going to be a higher savings rate on the other side. And that sort of how the Great Depression in the 30s altered behavior for a generation. I think that could be the case this time around as well, even with a vaccine. So,
I have a non-market question. New York, really, the curve was flat and it was smashed. It went back to the base. So my question is, Peter, because you're on that network a lot, is why aren't people, if New York is under control, why aren't anchors and guests coming into the studio and still doing their programming remotely if New York is so great?
Well, I still think that it's trying to be, staggered. I think that right now, until there's
A vaccine.
antivirals, they're just playing it safe, and they found it to be effective to be able to be distant and still do their shows. So
yeah, it's nice to be able to see everyone's living room, don't you think, Peter?
Yeah, it's been engaged on how people live. I do want to point out that I'm still mystified, or maybe not that mystified, but still scratch my head when you see the 10-year yield at 65 basis points.
Yeah,
where it was even last Monday.
Did the Fed take the bond market away from us after things froze, and they came in and said they were going to back corporates and high yield? And TLT used to be a great trading instrument. It's not anymore. You almost have to make an appointment to do a trade. Has the Fed taken away another market from us?
Yeah, unfortunately for now, yes. Just as the ECB killed the European bond market and the BOJ did the same in Japan. I do think, though, there is still some hopeful market signals in the Treasury market, and it hasn't been completely killed. But we don't know. I don't know whether the 10-year yield at 65 basis points is telling me that we still got a long road to hoe here in the economy, or it's telling me that the Fed's going to do yield curve control at some point, and the Fed's still doing QE, and I don't care what's going on around me. I'm going to continue to buy treasuries. So I'm not sure, but I think it's probably a combination of that. And being a combination of that still implies that there's still some economic signals that are filtering into the long end of the curve. And those signals certainly are being interpreted in a much different way than certain areas of the U.S. stock market.
Yeah, it looks like an EKG, right, of someone in a coma. So, okay, so we have uncertainty, and that not really being able to, like, you want to price risk, you'd like to be able to really price interest rates into that model. It's hard to do that. I do want to congratulate you. I remember asking you last time, and you've been constructive precious metals for a few years now, Peter, and I think silver had made a decent run. And I said, what do you think about silver in here? And you said, still has, quote unquote, still has a long runway. So we've gotten a lot further down the runway, challenging some yearly highs. I'm assuming that you're still bullish, constructive precious metals here.
I am. I think we will continue to see falling real rates. I think that in 2021, the story will shift to inflation. I think people don't appreciate the supply side disruptions that this virus has caused.
Okay. Yeah.
And that when the global economy continues to rebound, and if we do get a vaccine, that the demand for goods and services will overwhelm the economy's ability to supply it. That will lead to higher inflation, that will lead to even lower real rates and higher values of precious metals. Silver, about half the demand is still industrial, so it does have economic sensitivity, but it has economic sensitivity in secular growth drivers like electric vehicles and renewable energy and electronics and so on. So I still think there's a lot of catch-up play in the price of silver relative to gold. Both will go up, but silver has the opportunity to really outperform gold here on the next leg higher of what I believe is now, is a bull market in precious metals.
Okay, so even down here, and I'm showing it, Peter, the magnitude of the gold silver ratio coming in, where you could have gotten 125 ounces of silver for 1 ounce of gold, all the way down here at 94. You're expecting a continuation of the gold silver ratio to contract.
So if you extend that chart to the 1970s, when we came off the gold standard, the gold silver ratio on average is about 60.
Here you go, Peter.
Yeah. So
okay.
That goes back to 07. 60 is the long-term average going back to the 1970s when we had our last bull market in precious metals.
Well, I think this was a pretty important low back in 2011. So 30, I hadn't seen that for a while, but you're saying in the 70s it was where, in the 20s?
Well, no, the average since the 1970s is 60.
Okay.
So so I still think that there's room to get back to that long-term average.
Okay. Yeah, I remember 40s in the 80s, 70s when I was young. So we've covered. Yeah, go ahead, Steve.
Yeah, Peter, you mentioned the disconnect between the markets, financial markets, and the stock markets specifically, and the real economy. I think there is no doubt that the goal here is to keep supporting the stock market until there is an actual rebound in the real economy. So then they can, in essence, let them decouple, move in tandem. Do you think they can actually succeed in doing that? I mean, do you think they can actually succeed in having stock indices completely ignore the real damage to the economy until the economy is not damaged anymore?
Well, it is a great question. I mean, I guess it's one of those things that they can until they can't. That's the irony of the situation, is that if the economy does improve, well, then interest rates really do need to go higher. And that alone creates its own speed bump to any economic recovery. And then the Fed is going to be put into a situation where CPI is not going to be 1 to 1.5. It's going to be 2.5 to 3, 3.5 to 4 on an economic rebound. And they're not going to be able to just sit there with monetary policy currently where it is. So so that's the thing. That's the irony, is that a stronger economic recovery actually can lead to higher interest rates and lower stocks, whereas weakness, as we saw in the 10 years after the Great Recession, very anemic economic growth, but a very robust stock market.
So a recovery could kill valuations.
Yes, that's the irony here, because the recovery leads to higher rates, which would then create its own speed bump on any recovery, because the economy can't handle any notable rise in interest rates. The market certainly can't, but that's what you will get if I'm right on inflation. Now, I'm actually hoping I'm wrong on higher inflation, because that would be a disaster, I believe. That's the kryptonite of markets, and certainly of central bank policy. So I actually hope I'm wrong on higher inflation.
Do you still have your win button from the 70s?
Is that, at the end of the day, is that really a bad thing? I mean, is it really a bad thing for the central bank policy to finally fail? I mean, isn't this probably the ticket for a next day with, much more prudent handling of monetary policy and the economies? Yes, it's going to be very tough when it happens. But I mean, inevitably it will happen at some point, right?
It will. It will. I mean, in terms of control, and you look at, I always like to look at the Bank of Japan. Certainly, they've been able to manhandle the JGB market, but 30 years of easing still has the Nikkei almost 50% below where it was in 1989. So it's a perfect example of a central bank that can't bully in stock market. I mean, the Italian stock market is down 50% from its 07 high with all the things that the ECB has done. So there are plenty of examples of where central banks are successful in manipulating interest rates because that's what they directly control. But that doesn't mean that it's always good for one stock market. And the stock market at some point becomes more a reflection of the growth profile rather than just following a central bank balance sheet.
One more question. You mentioned the deficits, and we've been talking about them all the time. Actually, my personal prediction here was that during the next recession, and that was years ago, the US deficits are going to hit 12%, but I was wrong. It seems they're going to be a lot higher. What is the threshold? When do you actually think that the market is going to say, okay, that's enough. I don't believe anymore that the US can ever repay its debts? I mean, how far do you think they can push the envelope before something like that happens?
Well, I mean, it was the mid 1980s when we were talking about the exploding budget deficit and what that potentially can mean for interest rates. And here we are 35 years later. So it's really difficult to say. I mean, it'll matter when it does. And it certainly hasn't mattered in Europe. It hasn't mattered in Japan. So I'm not exactly clear when it matters here. It has the potential of mattering if the dollar does go on a sustained decline because foreigners own a third of the US Treasury market. And foreigners are not going to just want to sit there and watch the value of their US assets decline if the dollar declines in a notable way. So I'm really focused on where the dollar goes from here in determining whether all these deficits will eventually matter for the Treasury market.
Okay, Peter, you bring this up and you brought up Italy, and it had me flash back to a guest that I had on Monday who is actually looking for the next big financial problem. Ground zero is going to be Italy, a bank in Italy, and some type of parliamentary vote in early August 8th, that could threaten that Italy's politics may take them out of the currency union. Do you foresee? Are you paying attention to what's happening over there? I mean, the Great Recession was triggered here. Could it be a European bank that's the next shoe to drop? And everyone really knows that most Italian banks are zombie banks.
Yeah, I mean that's been the case
for a long time.
Yeah, I mean the ECB has obviously crushed profitability, and it's why European growth will just be anemic for a while. I think because of the state involvement in the economy there, it'll just be natural for them to recapitalize. I'm really, in a way, more worried about where interest rates go next year if I'm right on inflation. To me, that's really the next. I mean, when you look back over the last 10 years and where the excesses are, it's obviously in debt, it's obviously in interest rates, it's obviously in central banks. And what upsets the entire apple cart is higher inflation. And obviously we're in a deflationary period right now because the economy is so challenged. But if you get a vaccine and the economy's rebound, I'll say again that the supply disruptions that we've seen are not easily repaired. And I'd be surprised if we didn't have 3% plus CPI prints at some point next year.
Aren't we already seeing it in the grocery stores? Could it be foreshadowing what's going to happen everywhere?
Yeah, so I've been writing about that. I think is a dress rehearsal for what we're going to see at some point next year. And it's not just that; it's also in transportation too. I mean, good luck getting a truck to deliver things that you need, or getting a ship, because a lot of capacity is taken offline. I mean, look at the airline industry. When travel starts to pick up because people feel more comfortable because maybe there's a vaccine or effective antivirals, the airline companies are not going to be so quick to bring back capacity. It's not so easy to snap your finger and bring back 35,000 people that you just laid off, whether it's flight attendants or pilots. It's going to take time. So you're going to have full airlines, and you're going to have much higher prices. Now, again, that's probably a 2021 event, but that is what I see ahead of us. And you can be sure that central banks will overstay their welcome with all this easing and won't be so quick to remove the punch bowl. So to me, that is what upsets everything is higher inflation. And again, I hope I'm wrong, because that would be a real mess for credit markets and interest rates. And then obviously that has a spillover into the valuations of equities, which are extraordinarily overpriced right now, because I still think it's going to be years before we get back to the profit level of 2019.
So your headline for today, and only Peter Bookvar could come up with it, is that a recovery could end the recovery.
Yeah, it can end the recovery in markets. Yeah, I mean, wouldn't it be ironic that the markets bottomed at the height of the shutdown and topped out on the reopening?
I was thinking about that. Yeah, a vaccine. Yeah, interesting. Peter, thank you so much, buddy, for being with us today. I just want to
thanks, Dale.
Show people
Thank you, Peter.
your blog.
Thank you.
And let's see, where are you, Peter? Yeah, here you are. And people could subscribe to this. There's Peter's blog right there.
Thank you.
And something that, it's a great resource. You get this more in depth than you get on, Peter's 5-minute blurbs on CNBC. I think we're lucky that we have this format that we get to talk to him for a half an hour. So check Peter's blog out here. Thank you so much, Peter, for being here. What a nice twist on the whole thing, talking to a contrarian like you. I appreciate you.
I appreciate having me. Have a great weekend.
Okay, you too, Peter.
Okay.
Everyone, that's going to be a wrap. So remember, don't be worried about a recession. Be worried about a recovery. Everyone got that? The world upside down. And that's a wrap. I want to thank everyone for hanging out with us today. We'll see you tomorrow. Good hunting. Don't forget, you have to become part of this, because when we wrap, that's when things just start happening in the chat room. All right, so everyone's in there now. So continuation of the vibe that you have going here. In Face, you just, click on these two little people here, and Blake will answer your questions, Steve will answer your questions, and we have traders in there that it is not a hobby for. This is how they make their way in the world, by pulling pips out of the market. So that's a wrap, everyone. I'll see everyone tomorrow. Good hunting. You're very welcome. We have a blast laying it on the floor for you guys every day. It's our mission to build up and edify traders every day. Adios.